if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich.
Hey, welcome to the Crypto Network Spot. In this video, we will go over Warren Buffett's important investing principles to apply when investing. Before we get started, if you like crypto updates or investing videos that you can apply towards crypto or any other investing assets like this, please hit the like button and consider subscribing. This will help you build wealth and get closer to financial freedom. Now let's get into it.
Yes. I have an old-fashioned belief that I only should expect to make money in things that I understand. And when I say understand, I don't mean understand what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But of those 2,000 companies, 3 basically survive, and they haven't done that well many times. So how do you pick 3 winners out of 2,000? I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you bought companies across the board, you wouldn't have made any money because the economic characteristics of that business were not easy to define. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900. There's about 4 million horses now. So it's easy to figure out the losers. The loser is the horse. But the winner was the auto overall. But 2,000 companies just about failed. A few merged out and so on. There were 3 companies, auto companies, in the Dow Industrials in the 1920s and 30s. Studebaker, Nash Kelvinator, and Hudson Motor. Now those names are all familiar to me, and maybe some of them are familiar to you, but they're not making any cars. They didn't make money, and yet at one time they were in the Dow 30. They were the aristocrats of American business, and they got creamed. So figuring out the economic characteristics of the winners in a wonderful business is not easy. Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 48, from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of their reactions because they're human beings and they excited when others get excited. They get greedy when others get greedy. They get fearful when others get fearful. And they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. It doesn't take brains, it takes temperament. In terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire, because that's the way I want to live my life. I've got all the money I can possibly need. It just amounts to a change in the newspaper story on my obituary and the amount of money the foundation has. And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling all my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged, perhaps, with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high. In all likelihood, I mean, you can't make that 100% going to do. So that's our guiding principle. The advice is all free, and your marital advice, everything else.
Thank you for watching. Please don't forget to like, share, and subscribe. Also comment below and let us know what you think about Warren Buffett's investing principles. And again, thank you for watching. We'll see you in the next video.